trend is your friend until it bends. We think that a lot of the trends that started at the beginning of the 80s have ended. And it was with COVID. COVID was not necessarily the catalyst, but probably an accelerator.
Hello everyone and welcome to a new episode of The Blunt Dollar. Today's guest is Philippe Gijsels, Chief Strategy Officer at BNP Paribas Fortis. Philippe has been with the Fortis family for nearly 2 decades, long enough to witness its transformation into a core part of the BNP Paribas Group and to shape how investment strategy is communicated across one of Europe's major banking networks.
When you look at risks, a lot of people still think that cash is without risk. I put it in the bank account and it's there and it's safe because it cannot drop in value. And that's absolutely correct. It cannot drop in value in nominal terms. But of course, when you have massive inflation, it can drop in real terms. And that's one of the main messages that we bring to our clients, that cash is not a safe thing.
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Hello everyone and welcome to a new episode of The Blunt Dollar. Today's guest is Philippe Gijsels, Chief Strategy Officer at BNP Paribas Fortis. Philippe has been with the Fortis family for nearly 2 decades, long enough to witness its transformation into a core part of the BNP Paribas Group and to shape how investment strategy is communicated across one of Europe's major banking networks. What makes Philippe stand out isn't just his strategic position, it's the way he blends rigorous markets insight with literary curiosity, philosophical depth, and a rare sense of historical perspective. He's not just thinking about the next quarter, he's thinking in decades, in global systems, and in human behavior. He recently co-authored The New World Economy in 5 Trends, a book that looks at the forces shaping markets today, from hyper-innovation to inflation, climate transition, and the return of geopolitical complexity. In this episode, we explore how stories and signals from the real economy still matter and why being a strategist in today's world means being part economist, part historian, and part psychologist. Philippe, I'm incredibly excited to have you on the show. Welcome to The Blunt Dollar.
Thank you very much, Ignacio, and thank you for the very kind words, 2 kind words, because you do me too much credit, but I'm excited to be here, so thanks for having me.
Quite frankly, you are a superstar. I mean, I was doing the research for this episode, and there's so much content about you online, on YouTube, on the internet, and so on. So it was really, really easy to collect interesting things to talk about. But I'd like to start talking about your journey. You said your love for markets started very, very young, talking about equities around the dinner table and making mistakes early. Can you maybe walk us through that journey from apparently reading reminiscences of a stock operator when you were 14 years old to becoming the chief strategist you are today?
12, 13, 14 years old. So my father worked in a bank, a competitor of our bank. So I never wanted to start there because I did not want to be in the same bank as my father was. But indeed, around the dinner table, we discussed markets, we discussed equities, we discussed option markets. I've vivid reminiscence of the 1987 crash, for example. I was 87 back then, and indeed you mentioned the book Reminiscence of a Stock Operator about the life of Jesse Livermore. Another one is Michael Lewis, Liar's Poker. So that used to be the things I would be reading on the beach. And then I thought, this is absolutely fascinating. And then there was no internet back then, so you had to look stock prices up in newspapers and stuff like that. And then I realized, hey, these things are moving. So if I can buy at 100 and sell at 130, I make a very nice profit. So that got me hooked. And I quickly realized, I think, that everything that stock prices were, and I still believe this today, is somehow a reflection of the world. So if you could, in a way, understand the world, you could make money in the stock market. And that was the idea. And then, of course, you start to make every possible mistake that you can make. Because the first thing I remember, the very first, the audience will probably not even remember it because it's long ago. But the very first stock I bought was Olivetti, and Olivetti was an old Italian typewriter maker, and that was
Hmm.
transforming itself in a computer maker. But okay, they were not very successful. But the idea was you would start to look up in newspapers the stock prices, and then you would say, hey, this is the lowest price that the thing has ever been, so let's buy this because it's so low that it can only go higher. But of course it went bankrupt, so that was a very bad idea. Don't buy stuff that's low, buy stuff that's high. Okay, then the second part was, if I'm not buying things that are low, let me buy things that are cheap. Let me buy things with the low price earnings and so on. And then, of course, you start to buy steel makers and all the cyclical stuff. And the journey carried on and on and on. So I made every possible mistake in the book. And if experience is an accumulation of all the errors that you've made, well, I have a lot of experience. And even today, I make mistakes all the time. But that's the journey that you're on. And I find it, and you hear it probably in my voice, still absolutely fascinating doing this.
It's funny because when I was 14, I was thinking about soccer and getting a girlfriend, and you were
Yeah.
already talking about options.
Yeah, the girlfriend came much later in my life. I was 29 when I married, so indeed, there I got a little bit. I was early in equities. I was late in the girls' part, but anyway.
So in different interviews and in your book, you constantly reference philosophy, psychology, history, literature, and not just finance as a source of knowledge. What disciplines outside of economics have shaped the most the way you think about the world and about markets?
Well, you have already mentioned quite a bit of them. So there is psychology, sociology, and there is, of course, also history and the storytelling. Because at the end of the day, I think um, markets are a lot about stories that are being told, and some of them are correct, some of them are absolutely wrong, but in the short term, they do matter. And I always say if you go back basically to also to economics and to markets, but mostly to economics, they've looked at markets a very long time, like it's mathematics or it's physics or something like that. And the Chicago school, Eugene Fama and others, which is a brilliant man, by the way, but they really wanted to push economics in a direction is it has to be an exact science, and we need models to understand the world, and it has to be mathematically okay. And I believe that that's the case, but it's way more than only figures, because you have to know at the end of the day, markets are about people and they're about
Hmm.
feelings. It's about greed. It's about fear. And I'm writing a new book, and that's already a spoiler alert. And it's going to go once again. I'm writing two books, by the way. I'm writing a novel, which is also setting in financial markets, but also, once again, a book about trend following and about trading and so on. And yeah, there you see that markets are living things, and you really need these stories because they're driving, in a way, the markets going forward. And in the book, I talk about three windows on the world. I say, okay, there is a window, and I call this a library. And I'm not that I'm at the beach today, so normally when you see the background, there are a lot of books. So that's the first window on the world. That's a big library where you have all the research papers, where you have all the books, where you have all the ideas from all these different disciplines, and basically you study. And you study and you study an whole evening and a night, and you come to the conclusion, hey, let's buy biotech, just to name something. But then you look to your second window on the world. This is close by because the sea is only 100 meters from where I'm sitting today. And that's the sea, that's the beach bar, that's the waves. And you already know where I'm going. That is your Bloomberg screen. These are the charts you look at. And if you say in the first room, let's buy biotech, but it looks like this, yeah, probably your timing is off, or maybe your analysis is wrong. So that's the second window on the world. And then the third one, is about, I call this a congress center, but we could also call it a campfire, so where the people sit around and tell the stories. And in my profession, I have the luck to be in contact with CEOs of companies, investors, and so on. So you can test all the time your ideas, your hypothesis. When you say the European economy or the Belgian economy is going extremely well, but you talk to the big transporters, you talk to the people from the port of Antwerp or somewhere else, and they all say, we're not transporting anything, and our order books are absolutely empty. Well, you're probably wrong as well. So it's a combination of these three windows. And to your question, all these disciplines come together. And the more I study, and we'll probably talk about it today as well, market history is important because I've been in markets for a very long time. But when I was 12, I was born in 1970. So in 1982, I was 12 years old. So that was about when I started. But that was really the top in interest rates, the top in inflation. And I know you're a fixed income guy, so you know this. And from 82 onwards, well, all the time inflation was well behaved. All the time interest rates came down. So if you want to learn about a period where inflation is going up, like the 70s, well, you have to look in history books because some things are beyond your own memory or your own things you've actually seen. So sometimes that's what Ray Dalio says so well in his books. Sometimes you have to study history because if you want to know something that happened 200 or 300 years ago, well, you have to take a history book. So history is extremely important as well.
Big fan of Ray Dalio's books also. Principles, for example, I really enjoyed. And yeah, I love your analogies with the three elements to look at the world. So the library, the sea, and the Congress Center. And I feel they're all equally important, right? Like one cannot really
No,
live without the others. If you want to be a successful investor and have a complete investment thesis and get it right, you got to go through each of them. If you skip one of those, odds are that things are not going to get good. But you touched upon something that I was planning to touch upon later on in the conversation, but I'm very passionate about, which is storytelling. So I completely agree with what you said about storytelling and its importance. It's one of my objectives for 2025. I want to get better at storytelling. My question for you is, apart from reading, apart from studying, apart from looking at my Bloomberg, and apart from talking to others, how does one become really, really good at storytelling? What do the best storytellers in the world have in common, in your view?
well, I think first of all, you gave a lot of compliments at the beginning of the interview. Let me give you one. You're a very good storyteller because I've listened to quite a bit of your podcast and you do this very naturally. So I think you're way too modest in saying that we all need to get better all the time. We have to work on things, but you do this extremely, extremely well. So that's the first
Thank you.
thing. Second thing is, well, yeah, first of all, you have to like it because if you don't like it, you're never going to do it. I think it's something that's partly born. It's nature and nurture, right? Once again, it's who you are, what you want to be, and of course, if you really want to be it, you can also get better at it by studying. And therefore, I read a lot of books, and not only about markets, but about people who can tell a story. And I always said, and I'm a big fan of Michael Covell. If you could get him on your podcast, he has his own podcast, but he's fantastic. He's one of the very big guys. He wrote a book, Trend Following, and also about the turtle traders and so on. So I always said I want the book to be half Michael Covell. That's more the technical part, but also the storytelling part. And then somebody totally different, Erin Morningstar, and she is the writer of fantasy books, Night Circus, and one of my all-time favorites, The Starless Sea. It's so beautiful. And what you do when you write books or you do a lot of presentations, I do a couple of hundred of them a year. Well, when you start reading a book, you read for the beauty of it, you read for the content, but you also read for the structure. Because if you read something and you said, this is absolutely fabulous. Oh, somebody is able to put this or to phrase this. And then you start stealing from everybody, because in our book, and when you steal from one guy, well, you can go to jail even for that. But if you steal from 150 different people, well, we call it research. And that's basically what we have done in our book. When you read our book, you will immediately see the love of books that I have, because the quotes everywhere. So you try to steal. There is even a book, and I don't know who has written it exactly anymore, but it's steal like an artist. You steal with your eyes. You take something, and if you feel somebody, Ray Dalio or whoever, this said this so eloquently, well, you try to learn from that, and that's absolutely fascinating. But it's also a journey that's never ending and never finished, because you can always learn. A book that also helped me a lot was Joseph Campbell, The Hero with a Thousand Faces. And the main idea of that book is that all through history, to the campfires, when we were the mammoth hunters and so on, we tell stories, but basically we tell 7 or 8 stories all over, all the time again. And then you see there are big similarities between Harry Potter and Star Wars, for example. If you take Lord of the Rings, the journey, well, that's also the journey of Luke Skywalker.
The
That's
hero
also the
journey.
journey, the hero journey. Yeah, the hero with the thousand faces. And there is
Mm.
also another one, and I think hero is also in the title. I do not quite remember, but that's exactly what it is. And I loved your previous podcast with Morgan, I think her name was, about the hogs and the doves. She also talked about taking complex things and somehow tell a story about it, around it, that people understand, and it sticks. I did. I'm sorry, I'm going too much detail, but I did a presentation quite a number of years ago, and it was about the stock market, and the stock market was not too hot, not too cold. So inflation was perfect. Interest rates were at the perfect level. Growth was not too hot, not too cold, exactly in the middle. And I said, I have an aunt, and she passed away, unfortunately, in the meantime. And she would take, I started with the idea, she is going for a walk each and every day. But the temperature has to be between 23 degrees and 27. There can be no wind and there can be no rain. So I said she goes on a walk every day, but in practice it's only 10 times a year that she does that. And then I said the market is exactly today like those 10 days. It's perfect. It's not raining. There's no wind. The temperature is perfect. So this cannot remain like this forever. But at this moment, the market is perfect. And maybe 5 or 10 years ago, a guy who attended the presentation probably forgot everything I ever said about it, but he asked me, how's your aunt? So these are the things that stick in the minds of people. And if you can use that in your storytelling, well, you can somehow convey your story. And yeah, I love that.
Yeah. There's something very powerful about stories, which is that they stick in your brain better than just like dry numbers. And again, going back to the example, I guess, of the campfire and prehistoric times, that's the way people were sharing knowledge, right? Like with stories. So I guess we are genetically predefined to remember these things. By the way, whilst you were talking, you gave a number that captured my attention and I wanted to go back to it. 200. You said 200 presentations a year.
Yeah.
So two questions. First of all, do you ever see your wife? And two, do you get nervous or is this like so routine now that you never get nervous when you present anymore?
Well, first of all, my wife is more or less okay with what I do, so I try to catch up with some quality time with her and with the kids. So I think it's okay. She has not kicked me out for the last 30 years, so I think
Good.
I'm not knocking on wood, but that's okay. Nervous for the presentation itself, not really, but it's not over prepared. It's a little bit like we do today, because I want to be it a little bit natural. Because if you get over prepared, well, you start to be like a robot. And okay, these presentations, when I do one today and one tomorrow, okay, they will be similar. But okay, so maybe the story that I tell tomorrow will be a little bit different than before. So there's always this variation. Where my point of stress is, I'm the worst driver in Western Europe. I don't like driving a car, so I do a lot by train, by bus, by taxi, whatever. But I don't like driving a car. So if I have to go by car, I get nervous, and I'm also nervous to get there in time. So I'm always there 2 hours in advance at least. But once I'm on stage, normally it's okay because then I'm doing something that I love and also with enough modesty to know that you cannot know everything. And there are also questions you will not be able to answer. And when somebody asks you something that you absolutely do not know, then you say, okay, I'll look it up. I come back to you. Let me think about it. So if you approach it in that way, you don't have to be nervous. So I'm not really nervous of presentation. So that's okay.
That's good. And I guess, I mean, practice makes perfect. So the more you get exposed to that situation, the least anxious you are. Let's talk about your book. You co-authored the New World Economy in five trends, which is not just a book, but a way to reframe how investors think about this moment in history we are in right now. Why did you write this book, and what's the core message you want your readers to take away from it?
Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Yeah, that's already, you pointed already to it. I thought, and then Koen, my co-author, chief economist at our bank, and we're also we're colleagues, but also friends. We do also a lot of presentations together, so we're a little bit partners in crime. We both felt at the same time that the world was profoundly changing, and you have these big turning points, and then the last one I already mentioned was the top in inflation, top in interest rates, beginning of the 80s. And then Volcker was president of the Federal Reserve, and then after that you got Greenspan and a succession of Fed presidents, but always with lower interest rates, always with inflation that was coming down or was well behaved, always with central banks at their hands free to cut interest rates or do QE whenever there was a crisis because inflation was not a problem, with commodity prices that were low and not too volatile. So a fantastic environment for companies. If you are a company and each and every time you have to roll your credit book, you can do it at a lower level. That's fantastic. If wage inflation is not a big problem, that's fantastic. If your inputs are commodities and they're well behaved, they're not going up, they're not too volatile, it's fantastic. But we think that with COVID, the world once again profoundly changed, and we will be living in a world, I think, where fortunes can be made, but also can be lost. Because typically, and I'm a trend follower, I try to see big trends. I like to go with the trends. And I don't know exactly who said it, but I always say the trend is your friend until it bends or until it ends. Well, we think that a lot of the trends that started at the beginning of the 80s have ended. And it was with COVID. COVID was not necessarily the catalyst, but probably an accelerator to this, because even without COVID, we would have had this. But this is once again a world where geopolitics become complicated. This is a world where inflation will go up, where interest rates will go up. I think we're at the very first inning of a major bull market in commodities, in gold and silver, in a lot of things. So I think the world has profoundly changed, and people. They call it in psychology, they call it recency bias, which means we tend to extrapolate the past just behind us into the future, and that works 90 to 95% of the time very well. Only at inflection points it does not work, and this is, in my mind, an inflection point. And what my main part of the job is, besides talking, is somehow advising investors, advising companies to how they should make their company or their investment future proof. And therefore, I think it was a very good time to write this book.
So in your book, you identify 5 forces that are shaping the future: superinflation, hyperinnovation, climate transition, demographic aging, and deglobalization.
Yeah.
How did you arrive at these 5, and why do they matter more than others?
Well, we look at a lot of things, and we were able to put all the ideas in 5 big trends. We could have had 6 or 7, but we think all the big things that are very important are in these 5 trends. And there is one standing out, and that's innovation. Because the 4 others that you've mentioned are, in our mind, very inflationary. The demographic situation is inflationary. The fact that we do not call it deglobalization, but we call it multi-globalization. So it's not really less globalization, but it's globalization in another way. In a world where the United States is no longer the only superpower, you have China, which is more the rule than the exception, because one superpower like Rome was so many centuries ago is very much the exception. Typically, you have more centers, but if you have more centers, typically you also have more volatility in the world. So that's the way it's going to be. And if people start to, unfortunately, embark on wars, start to make their defense budget go up, and all these things, well, this is inflationary. War is deflation. Peace is deflationary, war is inflationary. So that's a point. The climate change is going to cost a lot of money. So that's also very inflationary. And then in my mind, the most important of all, and not predicting, and that's once again, and I'm very interested in your thoughts about it, but if you look at fixed income, debts are very high in a lot of countries, also in the United States. And in my mind, the only way to keep that debt more or less manageable is let inflation run. And then you have, of course, the innovation. And we all know that technology and innovation tends to be deflationary. And now AI is coming up, quantum computing is coming up. So the main conclusion is we were going to live in a world where inflation, interest rates are higher. But we have to know that there is an innovation thing which could go extremely fast and extremely hard, which can counterbalance the 4 others. And I want to stress this maybe. Our book talks a lot about challenges, a lot about risks, but is in a way an optimistic book, because we think that human ingenuity and so on will be able to overcome eventually all these issues. And then when I sign books, I very often write, this world needs less prophets, but more wizards. We don't need people who tell us we're all going to die or we're all going to drown because of the climate change. Now we need the young, but also the older people. But we always put a lot of faith in the new generation. I've a son of 21 and a daughter of 19. So, and their friends. You say that these are the people who have to invent the smart grid and the batteries of the future and so on. So we need a lot of Harry Potters, basically. And that's the probably the most optimistic chapter of the 5, because the innovation part will in a way be able to counterbalance hopefully the other 4.
I love the optimism. I'm an optimist by nature too, so I like that. From the 5, the one that caught my eye the most, maybe because I'm a fixed income guy, as you said, is the inflation one, the superinflation.
Yeah.
I like how you call that, instead of hyperinflation, but superinflation. One of the central arguments is that money is losing value faster than most people realize. Can we dig a little bit more into this one? Like, what does superinflation mean to you? Is it, you said, like maybe something necessary to be able to manage the huge fiscal burdens that many governments around the world have? And yeah, what are you going to be watching at in the upcoming years regarding that theme?
Well, I think that's indeed the most important one. And in one of your previous podcasts, you said, or one of your guests said, that interest rates and inflation are the price of money, are the most important thing in the world economy. And that's has been the case for many years, and that will be the case in the future as well. And there is, I forgot his first name, but Mr. Chandler has written a book about it. He's a historian as well, financial historian. and he has written the price of time, because he does not really calls it the price of money, but the price of time, because interest rates enable you to time travel. You can take cash flows in the future and you can bring them back to today. So interest rates are extremely important. And when you live in a world like we have lived for many, many years, where interest rates are very, very low and are even sometimes negative, well, there is no price of time and no price of money. So it means when you do an investment project, and you, of course, you have to pay a loan, but if you only have to pay 2%, well, your investment project only has to yield 4 or 5 to do it. When interest rates all of a sudden are 6%, well, you need to 7 or 8 to do it. So the impact on the economy is big. And I think that's not good news, because that's maybe the most depressing chapter in the book, the one about debt, and that's the one that Koen has written. I only have written 4 pages in that, and he's written most of them because it's really depressing. But which is absolutely right, because when governments have so much debt, the only way to make this more bearable is by, in real terms, by devaluing it. And if you do a thought experiment and you say let's add a zero to everything that we do, well, all of a sudden your debt has disappeared. And that's something that also, I think that Morgan said that also last time. Sorry, keep quoting her, but I really loved the podcast and invite everybody to listen to it. She said at a certain moment in time, when you look at risks, a lot of people still think that cash is without risk. I put it in the bank account and it's there and it's safe because it cannot drop in value. And that's absolutely correct. It cannot drop in value in nominal terms. But of course, when you have massive inflation, it can drop in real terms. It's also about education, that when you are in a world where inflation was extremely low, the value of your money also decreases, but it decreases at a relatively decent pace. But of course, when you get inflation running at 3 or 4%, and you do that 10 years in a row, well, in 10 years' time, you're absolutely convinced or absolutely sure that you will have lost half your purchasing power. And that's extremely important. And that's why we say this world, in a world where inflation is higher and where interest rates are higher, you need real assets. And real assets are equities, are commodities, are gold, are silver, is real estate, is wine, is old timers, is pigeons, is jewelry. So everything that's tangible. And that's a totally different environment. And in a way, I think we're back to something that resembles, and it's not totally the same, but something that resembles the 70s. I think we're back in that environment. And yeah, that's very important. So this inflation thing is very important. And what's happening to the Fed, and you know that very well from your fixed income studies, is that the Fed should be, we can question about it, but should be independent. But the independence of the Fed is very much at stake at the moment, with a lot of things that are happening. Powell is going to leave in a while. Some other governors have been appointed, so probably they will have a more dovish, to use the term, dovish view on inflation. So they will let inflation run, and that in a way will eat away the purchasing power of money. And that's, I think, instrumental that people understand this, that this is a totally, totally different ball game than we have seen over the last 30, 40 years.
Mm-hmm. Yeah, inflation, I like to say, is enemy number one of fixed income investors, at least those buying nominal bonds, because it erodes your cash flows over time, at least the real value of them. You said pigeons. Is pigeons an asset class, or did you just say that like randomly?
No, I did not say that randomly, and then that's I use that in presentations, and I always get questions about it. A good friend of mine in Belgium, playing with pigeons is as a sport is very big. So you have pigeons, and they fly from somewhere in France back to their home, and the ones that basically are the fastest, they win. And there is quite a bit of money to be made with these things. So and I was with the guy, and that's the campfire again, or the Congress Center, and I did not know anything about this game, about this sport, but he explained to me, and even the Chinese, the rich Chinese, are investing quite a bit in these pigeons. And for example, when the wind comes from the east, the ones that where the home is also in the west basically have an advantage because the wind will blow them somewhere to the west. So they have three different teams of pigeons, let's say, one in the east, one in the middle of Belgium, and one in the west. And depending on how the wind blows, they will use team one, team two, or team three. So this is a very big business. And yeah, a pigeon that's really a champion and you can breed with it for the next generation. It goes many, many thousands of euros. So I always say, and that's not to make a distinction, I'm an equity guy my entire life. I believe strongly in the fact that we will be in a bull market for commodities. So I'm also a commodity guy. I do some real estate. But if real assets is for somebody else, wine, or is whiskey, for example, which has been a very good investment, by the way, for many, many years, or old timers, where the prices have gone up, or pigeons, that's all well for me because to do equities, you have to know something about the equity markets. To be in the pigeon business, you need to know something about pigeons. But if that's your game, it's perfect. And then again, I think the storytelling comes in because when I say pigeons, I get your attention. We talk a little bit about it. Somehow somehow resonates in the brain of the audience. And if you believe the pigeon story, maybe you also believe the commodity and the equity story. And then we have built a story that in a way demonstrates real assets and somehow fortifies it in the brain of the people. So that was my objective, and it seems to have worked.
Nice. If reincarnation exists and I get reincarnated into a pigeon, I want to make it to the Belgium national pigeon team. I'm sure that those birds are treated very, very well.
They're treated extremely well. Yeah, I can tell you. Yeah.
So talking about stories, I want to talk about another story in your book. I think it's in your book, yeah, about a Wall Street banker getting hustled in a backroom poker game, and the lesson is don't play games if you don't know the rules. And you talk about this thing called the Gamboni principle. So what does that story teach us about markets?
Well, that's a story that I first told, and I did not invent it. I read it somewhere in a book. Trader Vic, I think. Trader Vic, two books, one and two, about a Wall Street guy named Vic, of course. And I found that story there, and I told that as the intro, maybe already 20 years ago to our clients. And then it's a very nice story because I always say it's a famous banker, and I always say it's from Goldman Sachs or something. And he drives home in the evening. And okay, bad luck strikes because his car breaks down and then he goes to a garage in a little town somewhere on the road. And okay, he has to wait for 1 day or 2 days before his car is fixed. So he checks into an hotel and then he sits in his room and he's watching CNN a little bit or Fox, and he's getting a little bit bored. So he goes downstairs and there's a poker game going on. And then he says, okay, these peasants here in this little village, I'm this big Goldman Sachs trader. I will just clean them all up. So he buys some chips and he starts playing. And it goes back and forth a little bit. And then all of a sudden he gets a very nice hand, a flush or something like that, or a full house. And he starts raising the bets and so on. And certain moment there is quite a bit of money on the table, and the cards come on the table, and then the other guy shows a two of spades and a three of clubs, and then absolutely nothing. So he wants to take the money, and then the guy says, no, this is a Gamboni. And he said, I've never heard of a Gamboni. What's a Gamboni? Well, in this house, Gamboni beats everything. And look at the door. There is a paper over there which describes the rules of the game. And there indeed it says, when you have a Gamboni, you win. And it says, and exactly the Gamboni is on the table, so he cannot do anything about it. Says, fuck, that's not good news. So they start playing again. And game goes back and forth a little bit. And by chance or by luck, he gets a Gamboni. Gets exactly the same hand of cards, and he has a Gamboni, and then the stakes are raised again, and he puts his Rolex on the table, and he puts his car on the table, and because I'm a Gamboni, I have the best thing that's possible, so I'm going to win. Okay, it's square, and then the cards come on the table, and the other one shows a pair of fours, something like that, and he shows his Gamboni, and he wants to take the money, and everybody starts laughing. He says, why are you laughing? Because I have a Gamboni. Then the guy says, look at the other side of the paper, and there it says, there is only one Gamboni allowed each evening, and he loses again. So, and he has to go home, a little bit poorer, but probably a little bit wiser. And the story you want to tell, don't play games where you don't know the rules. So if you want to be in the stock market or in the bond market or whatever you want to be, make sure that you know the rules, because otherwise you will end up as our poor Goldman Sachs trader went to walk back to his office after having lost everything.
Oh gosh, I'm not a big poker player, but for sure, if I play again and I get those cards, what was it, a 2 and a 3? I'll bring the Gamboni up and I say, Philip told me this wins everything.
Yeah.
Great story, by the way. And another story that you've touched upon briefly in the past is George Soros's concept of reflexivity, which is that the idea that markets participants influence the outcomes they're trying to predict. How important is reflexivity in today's environment, in your view?
Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
I think it has become even more important than it was already back in Soros' time. Or Soros is still involved in the markets, but not as much anymore than as he was in the 80s somewhere. I have mentioned Liar's Poker, Reminiscence of a Stock Operator. One of the very first book I read was also Alchemy of Finance by George Soros, and that was back in the day when he and Scott Bessent, by the way, because Scott Bessent was one of his lieutenants back then. They drove the pound out of the exchange rate mechanism. So he was a very big guy, and then you start studying this book, and the idea is, in a way, what you learn in high school or at university is that, in a way, the stock market has to be a reflection of the economic reality or the reality of companies. If a company does well or an economy does well, typically you have to make money, the stock price goes up, and so on and so forth. But it also works in the other way around, because if the stock price of a company goes up a lot, well, they have something that's very valuable, because they can use their stock price, their very elevated stock price, as money to buy other companies. A good example of that, and I think we also mentioned in the book, is AOL back in the day buying Time Warner with a very expensive stock. They could buy Time Warner for nothing. Of course, at the end of the day, AOL was worth nothing, and the only thing that remained was valuable was Time Warner, but it changed hands. And it goes further than that, because when a company is very successful, take Palantir, for example, today, and there's a big discussion whether this is a bubble or not a bubble, and then that's not the subject, but the stock price goes up. So it means that, they can buy competitors. They can buy back their own shares. They can raise capital easily. Because their stock price goes up, they have very nice option plans probably. So they probably have a good CIO. They can probably hire a lot of interesting people. And also the management, when things go well, and we call that a halo effect, they get some sort of a halo around their head. Nothing can go wrong. So they attract money, they attract people, they attract everything, and it becomes a self-fulfilling prophecy. So even if at the beginning they're not fantastically good, after a while, everybody thinks they're fantastically good, and they can do all kinds of nice stuff. Of course, when it goes wrong, it works the other way around, because then the halo disappears. The management can do nothing right, even when they do some things right. The stock price goes down, and they're at risk of being bought or by somebody else or going bankrupt. So this reflexivity is very important. And if you take that to a meta level, to a higher level, it's also what happens with the central banks, because they're so afraid that the stock market will go down. Because if the stock market goes down, well, it will have a negative impact on the consumer sentiment. It will have a negative impact on sentiment, on the real economy. So it's not only the real economy influencing the stock market, but if the stock market goes down too much, it influences the real economy. And central bankers know this very well, and therefore they're so worried, worried like hell almost, to let the stock market go down. And this explains, I think, if you look at the S&P 500, the last 15 to 17 years, each and every time you saw a serious correction, it was very short in duration, because each and every time central banks would come in and immediately support the stock market. So if you would have bought each and every dip, well, you would have made a lot of money. And therefore, everybody is conditioned today to buy the dip. And this works very well until it does not work anymore. So we should be aware of this mechanism. But this is the reflexivity. So I hope that I explained it a little bit understandably, because it's a complicated concept.
And do you see echoes of reflexivity in how media shapes expectations?
Yeah, that's an extremely good point. I think that narrative and then reflexivity and then other things are reinforced by social media, because you have all these social media platforms, and you have X, and you have all these things where all these stories float around, and everybody talks about the last technical breakout of something and so on. So this reinforces it. So that's one important thing. I think that's one of the reasons why this is even stronger than it was back in Soros' time, when there was no internet, or you could use you could read a newspaper or a book or something like that, but it is way slower. So no, this is instant. This is immediately. This is reinforcing. So this plays. And then another thing, and I think you wanted also to go there with this question in a way. It's not only stronger, but the question becomes very much what is still real, because we can make all kind of stuff. We can put it on social media, and how to distinguish between a message that's real or not real anymore, and even stories that are absolutely, and that you have these meme stocks in a certain way, and they build a very nice story around it, and it starts going up, and it starts to appear in all kind of these chat rooms and everywhere, and all of a sudden something that's not worth a lot goes up a lot. So I think this is the sign of the times, and yeah, this is something which is dangerous, because these positive stories, they tend to reinforce themselves, but there are also stories that are absolutely built on nothing, and that can cost people at the end of the day quite a bit of money. So, but I think this is the new environment, and this will only become stronger. So social media, and that's also in a way storytelling, has become extremely strong, probably even dominant in the investment world that we live in today.
We could spend a whole episode talking about social media, but I have a couple other questions instead. So you've also referenced many times how humans think linearly from birth to death, but that markets often move in cycles. How do you help as a strategy your clients to reconcile their personal time horizons with these market cycles that sometimes stretch beyond their lifetime?
Yeah, that's difficult, and I would say that's an easy way out, but do a lot of talking. Talk a lot with them, and the time that banker came in, or an advisor or whatever, and then he would say, I'm going to explain you how the world works, and when you've done with that, I'm going to tell you what you have to buy and what you have to sell. I think that world is also far behind us. We in a way, we go into a dialogue. Well, a very important thing is in a way, and that's part of what I try to do with the clients I talk to on a regular basis, is when it gets too funny and too crazy and too exciting, then you say, should we not take some money off the table? Because this is going crazy, and sell at least half of it, because I don't know where the top is. And this can go on for another month or a year or whatever. But if you have sold half, well, you're still happy with the half that you have, and you can still make some money on that. If things go bad, it's easier to sell the second half because you already sold the first half. So do this in parts. If things happen like just after Liberation Day in April, or with COVID, we told clients, okay, this is maybe a good moment to buy, because we know that central banks will come in. We know that if the stock market goes down 30%, probably Donald Trump will change his narrative, which he did. We really encouraged from lockdown with taking videos and talking to our clients, and we got a lot of good marks and points for that, because clients really appreciated that we were there, even not physically, but when we talk to them. Then we say, at the moment of COVID, I said, I have no idea where the bottom is, because it was falling like a stone at a certain moment in time. But then we said, look, this pandemic is going to end at a certain moment in time. This is not forever. And secondly, central banks will throw whatever they have and the kitchen sink to it, just to stabilize the market. And that was a bit scary, because while we were taping these videos and talking to our clients, on my other screen you had the Bloomberg, and you saw it going down and down and down all the time. And you saw you're fixed income guy, so you know when central banks are in the market, you see them buying. It's a little bit like B-52 bombers that come in with the first rate and the second rate. And that was even more scary, because you saw them coming in, and initially it did not help. So you're telling everybody, I think it's okay, but you feel not too confident yourself, but you know they're going to come and it's going to help. And that's something you're not always right, but that clients remember and clients appreciate, that at the moment that everybody is scared, you're somebody who says it's going to be all right. And even more difficult, maybe when it's getting too crazy, somebody says, take some money off the table. And that's maybe, that's the longer term vision. And by the way, I think that's also what we try to do in our book. And when we talk about the book, one of the best books I've read, and we reference it as well, The Fourth Turning is Here by Neil Howe. If you could get this guy on your podcast, he's fantastic. He's a financial historian with all the also the big cycles and the big trends. And what we say, if you look at the world to this glasses, and you say, okay, then you see there is more structure to it than all the randomness that we see. All the randomness is very short term, but a Donald Trump, elections everywhere in Europe, unfortunately, that are lost by the incumbents. Unfortunately, the war in Ukraine, all the horrible things that are happening in Gaza, hopefully not in Taiwan, but there's also a possibility that something goes wrong over there. That are exactly the things you expect in a fourth turning. So if you look at the world with that perspective, you see a lot of order in the chaos. And that's at the end of the day, maybe what clients expect of us, that not that we're always right, but that we can build some frame of reference for them, that they understand the world maybe a little bit better. And if they understand the world a little bit better, then you can work towards more long-term goals, and you get away from the short-term goals.
So talking about frames of reference, another memorable framework that you use regularly is the alligator principle, which is cut your losses quickly or risk being eaten whole. Can you explain what this alligator principle means in practice, and how does it apply to strategy?
Well, it's easy to preach and easy to tell. In practice, not easy to do. Because what's the idea? This may be a little bit sinister, but when and I hope it never happens, but when you fall in the water and you're attacked by an alligator, the strategy of the alligator will be that they will take you in some sort of a grip somehow, and you cannot get loose. And the more that you struggle, for example, it takes you by the arm it's very sinister, I'm sorry, but it takes you by the arm or the leg, well, you, in a way, the more you try to get your leg free, it will take your arm as well, and eventually it will swallow you whole. So the only thing you can do with an alligator when it has your leg, sacrifice the leg and get away with what you have. So that's a bit what you have with the alligator principle. And if you, let's go to something that's more fun than being eaten by an alligator. You go to the stock market and you have a position, you lose 10 or 15%. The investment thesis that you put forward does not apply anymore. Things go absolutely wrong on the fundamental side. You see technically the picture deteriorating while you look at it. And you can say, well, it's 15%, but I'm not going to take that 15% loss. I wait a bit. And then it becomes 30 and 40 and at the end of the day, you've lost everything that you've put into it. So that's the alligator principle. Cut your losses short. And in investing, if you have two pieces of advice, or it's actually one, let your profits run and cut your losses short. And that's what we preach each and every day to our clients until you have to do that yourself. You have two equities, two different stocks. One, you have a profit of 30%. One, you lose 20%. And you want to go to the coast. You want to have a nice barbecue. You have to drink with friends. And what you do is, I take the 30% profit because that feels so fantastically good. And you know what? I let the 20% loss, I let the position run because it will be all right. And then you come back after 2 weeks and the thing you sold at the 30% up is up 50%, but you sold it. And the thing that was down 20% is also down 50%, but you still hold it. So that everybody knows that if there is one golden rule in investing, and it's not only equities, there's commodities, it's bonds, it's everything, let the profits run and cut the losses short. And it's extremely easy to write about it, extremely easy to explain that to everybody until you have to do that yourself. And then you need discipline, and then you have to have had enough Olivettis in your portfolio that became absolutely worthless to say, maybe this time I will do it differently. But still, after all these years, it's still very difficult.
Wow, I love that one. Gosh, I have so many of these analogies in my notes that you've said over the years. I mean, and I have so many of them, but we're getting close to the end of the conversation. So I'm gonna choose very wisely one last one, and then we'll wrap it up. But another one that I wanted to ask you about is this least wrong approach. You've said that in investing, it's not about being right all the time. It's about being least wrong, especially over time. So what does a least wrong mindset look like in practice?
Well, there is a book, and once again, yeah, there's always a book. Best Loser Wins, I think the title is. And it's about a trader as well, written by a trader, I believe. And I'm sorry, I'm not absolutely correct, but I love the book and I have it. In a way, we have to be humble because we cannot predict the world perfectly. We don't have a crystal ball. Anybody who says he has a crystal ball basically is probably telling a lie or probably making things look better than they actually are. But you can be a little bit better than the consensus. Where the money is made in markets is you have a consensus. We also know that the consensus shifts all the time, and the consensus is most of the time wrong. So if you can get this consensus a little bit better, looking through your three windows to the world, and then say, nah, maybe everybody is bullish on this, but I don't like the chart, or I don't like the fundamentals, or I just talked to a very intelligent guy and then he says something totally different. And then you can tweak your positioning a little bit and then you can make some money. But it's very hard to do. But I think that's the main thing. It's the future is by definition unknowledgeable. You will not know it, but you can try. And the fact that we cannot never know it perfectly should probably not prevent us of trying, at least. And if you're a little bit better than the consensus, you can make money. And then with the golden rule we talked about in a second ago, let the profits run and cut your losses short. And you also know that if you make 10 bets or 10 provisions or whatever, 10 forecasts, and you have 6 or maybe 7 right of the 10, you're absolutely fantastic, but you will not have 10 out of 10. Rarely, sometimes with sheer luck, but not in the long run. And that's the thing. But the best traders, the Druckenmillers and so on of this world, sometimes they get it even right only 4 or 5 times out of 10. But if you then manage to make more money to the upside and you lose to the downside, and you can indeed let your profits run and cut your losses short, well, you can make a lot of money. So that's a little bit. If I have maybe one advice, something I've learned over the many years, that we should be humble, that we should know that we will make a lot of mistakes. If you get it right 6 or 7 out of 10 times, you're really, really good. But try to make the most of the upside and let the alligators not eat you alive in the 2 or 3 times you're wrong, because they will be there all the time.
It reminds me a lot of golf. I play golf, and some of my best rounds and a lot of people's rounds are when the mistakes they make don't penalize them as much. And that's what differentiates often like the really good players from average or bad players. The good players, they have good bad shots, which don't penalize them extremely by going into the water or out of bounds. It's just like something that allows them to keep going. And yeah, I see some analogies there. All right, well, I have a last question that you kind of just answered, but I always like to wrap up my conversations with that. What would your advice be for someone entering the investment world? You gave a lot of advice during this conversation, but if you had to single out one of them, what would it be?
Well, this is maybe very not something you would expect from a banker, but I would say love what you do. That's very important. 20 years ago, I was a bit restless because when I was with the family, I thought I must be working, I must do something in the stock market. When I was doing in the stock market, I was worried that I was not in love with my kids. And then I read, this is maybe a final book, and you probably know it, and it's already a quite old book already, The 7 Habits of Highly Effective People by Stephen Covey. And there is one of these habits is begin with the end of mind in mind. So excuse me, but the end in mind. And that's one. It's again sinister because you're dead and you're lying in your coffin and you have the people that you like and love around you, your wife, your kids, your friends, your colleagues. And then the question is, what would you like them to say? And basically, first of all, I would like my wife to say, okay, it was certainly not perfect. He was no saint, but he did his best. And I would like my kids to say that was a dad that we could count on. He was there for us and so on. And the friends would say somebody we could depend on, and the colleagues. And then it's writer, and then it's trader, and then it's all the other things. So these things are the most important things. But if you ask about markets, I think love what you do is the most important thing, because otherwise you will not be able to look at markets for 14 or 15 hours a day, each and every day, if you don't love it. I say that sometimes to colleagues when they're in a bad mood or they say, oh, I don't like this or whatever. I say, if you don't like it, don't do it. Whatever job you do, and if you only have to do it 7 or 8 hours a day, not even 14 or 15, but you don't like it, find something else, because this is such a big part of your life. If you don't like it, find something else. So love what you do.
I love it. Great piece of advice. I think it applies really to any industry, any job, anyone listening to this podcast can use those wise words. Philippe, this has been absolutely amazing. Thank you so much for this conversation. I knew it was going to be a good one, but I wasn't expecting it to be this good. I hope the listeners enjoyed it as much as I did. I'm really looking forward to see your new book coming out whenever it's ready. Please let us know. For those of you that are not following Philippe on socials, please go and check him out on LinkedIn. He publishes there quite often. And then, of course, YouTube and the official BNP Paribas website and so on. He's featured quite often. Philippe, thank you so much for coming to the Blonde Dollar. You have a friend here now, and I look forward to the continuation of your journey as a strategist, and let's keep in touch.
Thank you very much for your time, for the opportunity. I cannot believe that we already talked for an hour, but that's always the best conversations. And I will clearly continue to follow your work because you have a number of very interesting guests on. So thank you very much for that.
The Blonde Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blonde Dollar for more raw, honest finance conversations.